Good morning, everybody. So, NCC Group Half Year results. It's going to be a normal agenda. I'll talk you through the overview of what has been, it's fair to say, a disappointing half for us. But I'll also take you through some of the positive aspects that we're going to see going forward and some of the drivers for the future. The headlines. Whichever way you cut it, these are good numbers. They're just not what we expect. 35% revenue growth, assurance growth 42%, escrow growth 14%, a 15% growth in group adjusted EBITDA. All those points are positive. Assurance profitability up, escrow profitability up, confidence in the organisation such that we're maintaining the dividend. They're all positive signals. We've done all the things that we always talked about. We've added PSC and we've added VSR to the group. Very high quality businesses in the security space. One very much into RMG, which is risk management and governance, and the other more a traditional security consultancy based in Boston. We've now got 1,909 employees, 35 offices. But it has been a difficult first half. We've talked about the contracts that we've lost. We didn't lose them to competitors. They didn't go to third parties. They were unrelated events that were cancellations that had a material impact, not just on the profitability, but the way that we set the group up, the investment decisions we make, the decisions we make around infrastructure and the people we employ. They all landed at once. That's never happened. We had issues around the relationship with the Dutch government, with Fox. Fox is a fantastic business. Let's be really clear about that. We're going to be doing a Capital Markets Day on the 22nd of February, and you will actually get the opportunity, if you choose to come, to see an awful lot of what Fox has to offer. Not only the advanced cryptography, but some of the managed services which they're renowned from in terms of threat intelligence. But the relationship with the Dutch government is a difficult one because the relationship that the Dutch government had with the UK government, and therefore making sure that the Dutch government believe that we as an organisation are not going to do things to their detriment with some of their most sophisticated cryptography is a journey that we could neither have foreseen and one that we found very difficult to embark and conclude on. I do believe we'll get there, but it's difficult. And the part of the business it affects is the very specialist high assurance area. And this is about creating physical products that actually provides secure communications. So, for example, battlefield communications. And of course, we all know that cryptography is one of the most important emerging aspects of cybersecurity. So it's a heartland that we want to be in. A lot has been made about the managed service contracts that have not been proving as good as we'd like. Yes, they've come out of accumuli. The problem is basically the number of them. It's not the value. It's more to do with the time-consuming effort of having to deal with lots and lots of small contracts and quite a lot of them stepping away from or losing. So whilst it's difficult in terms of the impact it has on the P&L, it's more about the management stretch that's created. Accumuli is fully integrated into the group. All the changes that have needed to take place have taken place. The business is certainly on the uptick in terms of the performance we would expect to get from it. In terms of the integration, Fox is still on that journey. What we did do is we've put a range out for our expectation for the year, a relatively tight range, 45.5 to 47.5 million. It's been coined our gap year. This is our year out. You can do two things with a gap year. You can either spend your time in the pub, or you can go and do something that's actually quite interesting and insightful, and something that sets you fair for your future life. This year is not a year in the pub. This is one we're actually working really hard to make sure everything we're doing sets us fair for future years. It's given us a period of time for quiet reflection, and with that, the way that we also report as an organisation. And we should report the way that we operate. And our plans are very much about making there an even greater level of transparency. We do actually believe we're pretty transparent as an organisation, But when you get to a position of having a year such as this, people can't quite unpick the numbers with the detail that perhaps they would like, suggests to us there are things we have to do differently. And there are some points that we've also turned around and had to acknowledge that we're doing things in a way that we need to explain more clearly. And that will be part of the process over the next 6 months. The Capital Markets Day, when we do the trading update, and at the year end. And as we come to some of the areas, I'll talk about some of the things we'll be doing. However, despite the disappointment, we've still got to look at this as a pretty positive situation. This is a very positive business. All the graphs are very positive. All the signals and indicators are very strong. And let's look at those numbers in a bit more detail. Overall, we've seen assurance growth of 42%. That's 21% organic growth. In security consultancy alone, that's 44% organic growth. Escrow. Escrow's grown by 14%. It's all organic. Domain services. We've come out of domain services. The final part of domain services, the open registry business, was sold. In terms of the carrying value compared to what we have received in consideration for it, it's about neutral, as we predicted. So that journey is now over. Mix of revenue. An interesting point here. We've finally moved to the point where more revenues are achieved outside of the UK. So it's now 51-49%, with the vast majority of the rest of the world obviously reflecting North America. And again, if we look at the group EBITDA, growth of 15%, margin of 17%, escrow holding firm at 57%, and assurance around about 13%. Now that is down. Again, I'm honest about that. That is very simply the consequence of the contracts that we had, which were considerably higher margin, and also some of our investment in people to ensure the future of assurance. The reconciliation of profit from EBITDA to pre-tax is very clear. What we've done is we have provided complete clarity over all the areas that you would need to construct a model. So there is no ambiguity. I'm very conscious in the market we had varying numbers of PBT around. I hope what we're doing here is actually helping people make sure that we get that back into line so that range stays clear. And also there's clear transparency. A point that actually isn't on here, and I will just touch on, is our tax rate. Our tax rate has changed. It's changed as a consequence of where we've actually derived profits from. We've got a higher proportion of profits from North America. In the past, we hadn't paid tax in North America because we had losses in domain services and acquired losses that we'd got from businesses we'd added to the group. And that's resulted in a change that tax will be running at an effective rate of about 31%. Going forward, it should fall to about 27%, but for planning purposes, I'd probably say 28%. So building prudence into that. In terms of EPS, we can see that that's fallen away, and that's a consequence of the way that depreciation and amortization has come through, and obviously the increase in the fully diluted number of shares. The key point on that page to me is the dividend. It's being retained. It's being maintained at the levels, and when we predict that our progressive policy at the year end will continue, I expect that we will be increasing the dividend in line with underlying earnings at the year end. Cash flow. Now, a lot's been talked about our cash flow, and there's a lot of myth and rumour about actually what's in it and what's not in it. One of the key metrics we've used is our conversion of operating cash flows into operating profits into operating cash flows. And the measure we've always used has been really, really consistent. It currently runs at 104%, which is less than it has been last year. And that's due to the change in mix of the business. You'd expect that. We're more of a consultancy business than we've ever been before, and that trend will continue. What we are going to do at the year end is we're actually going to change the way we measure this metric, because the way we measure it is to knock out a couple of exceptional items because they distort it. What we're actually going to do is go back to a pure conversion model and then add back things so people can see the underlying impacts. Because whichever way you look at NCC Group, it is extremely cash generative, just by the nature of the recurring revenues and the escrow business it has. And what I want to make sure is that actually everybody can see how that actually operates. So there will be changes afoot. And so therefore, let's actually talk about the key items on the balance sheet. Actually, it's 103% is the ratio of cash flow, not 104, my apologies. Parts of the drivers, you'll see, are trade and other receivables. Actually, the rate of growth in trade and other receivables is actually less than revenue growth. So we're pretty well in control of it. A key component of, as you would expect with a consultancy business, is accrued income. There it is, 23.8 million, grown 31%. Again, it's what you'd expect. Adding 2 small consultancies and the full year effect of Fox into the business is, of course, going to increase those numbers. It's just simple common sense. In terms of looking at debtor days and all of those things, you'll actually work it out for yourselves. You'll see if anything is getting marginally better. As a business, we've always been very close on cash. That's going to continue. Capitalised items. What do we capitalise? Well, when we create particular tools, particularly in the Fox business or the former Accumuli business to do with the SOCs, certain parts of that can be capitalised. It's all allowed under IAS 38. It's all audited, it's all approved, it's very clear. It's got a development plan, a beginning, a middle and end. And it's run at about 4.4 million. It will continue. It will probably continue at about that rate. And when the products come into use and are being sold, they're obviously then amortised over the useful expected life of them. CapEx, most of it is actually to do with offices. You know, we seem to have actually moved from being a people business to a property business. 35 offices. There is a need to actually get the facilities to the right standard, and this year and moving into the next year has been a big year of change. We've had to move in Manchester because we've run out of space. We're having to move in Chicago because we've run out of space. We've had to move in Cheltenham, we've run out of space. We've had to move in Reading, we've run out of space. And so therefore we put the appropriate investment in. And again, we don't do it in short-term decisions. The leases we take on are long-term. We build out for future growth and expectation. CapEx probably will fall after we complete the relocation. And again, we'll give you more guidance on future years' CapEx expectations. I think everyone's familiar with our banking position. And as expected, net debt decreased. The banking facility is 112 million. And the chunky bits that we've paid during the passage of the last 6 months are to do with the acquisitions we've made, the completed earn-out paid out in full for Fort Consult, and the deferred payment for Fox IT. An interesting little nuance on Fox IT is actually the consideration should have been paid in cash and shares. We as a board decided we prefer to pay in cash than shares at the current value. I'll let you draw your own conclusion on that. What we have got to come will be deferred consideration due on PSC and VSR. I expect those to be paid in full based on the current performance I've seen. And we have a further deferred payment on Fox IT. Assurance. Quite a startling number is actually the headcount. There are 1,612 people in our assurance division. In terms of our security consulting division, that means we actually have a bigger capability than many nation states. That's pretty scary. If we look at the key numbers, revenue growth 42%. If we strip out currency, that's a 36% growth. Organic growth 21%. US, very pleased about, 38% growth. And the EBITDA margin, as I've talked about, has fallen back to 13%. Now, are we going to get that to 20%? We will, but at no time soon. We're going to be very cautious in how we move the margin forward. And again, I don't want to lead expectation too hard. I don't want to push expectation too hard. Progressively working to return the margin back to that we used to. That will continue. Order books, remember our order books are completely contracted, nailed down order books. They're not hopes, they're not framework agreements, they're not things that will be delivered over 3 years. They're properly signed up orders that will be delivered traditionally within the next 3 months or so. What's also important there is actually the renewals level. 32 million of our assurance revenues are now recurring revenues. Breaking it out a little bit more. Now, when we've taken a step back and looked at this, and I've tried to position myself in the dark days on that side of the room, looking in at us and understanding why people have become uncertain about our performance, I've actually recognised that that is a really difficult number to take to bits because we don't give enough information. I've also recognised it's not necessarily the way that we operate as a business. And through the strategy days and management discussions that we've actually had a couple of important moments. It's not quite an epiphany, but it's not far off. We at NCC Group sell product. We're not independent in that way anymore. We have to recognise that. That's a big step forward. Now, that's not because we do brush sales of firewalls or equivalent DDoS mitigation solutions. We actually sell a lot of product out of Fox. We create a lot of product. Go on our website, you'll see brilliant propositions such as Piranha, which are anti-phishing products. We do quite a lot of this. And we sell on that basis, and our teams are structured that way. So we're going to start showing you a bit more clarity on that area. We have to recognise as well that despite our belief that the purity of the model in terms of deconstructing somebody's organisation, finding ways of breaching their security is perfectly pure, our customer base keeps turning around and saying, can you fix it, please? And actually, that's a pretty good question. Why don't we? Our problem was, would our consultants break things they know they can fix rather than break things that they don't know how to fix? And actually the simple answer was, we look at our software testing business, and in lots of situations, some of the work we're doing is around remediation. So as long as we keep the divorce between the two areas, it's something that we probably should be doing. And a lot of our leading clients, I'm talking about big insurance and banking organisations, are saying, please, will you do this? So again, we've had to start looking at how we report. So again, we're going to provide a little bit more information on that. I've already thrown a little appetizer out. Managed services revenues in there are 19 million. I bang on about how much of our recurring revenues you can actually see and the transparency of that, but do I give you a figure for what our revenue is? No, I don't. So to us, we feel we need to do that, and we feel we need to do it because that's how we sell. Fox is a recurring revenue business. Great chunks of the former Accumuli business around the SOC and the SIEM are in fact recurring revenue businesses. So what I'd like to believe is you're going to get a much better feel at the year end. Now, I can't promise that today. It would be wrong to do it on the hoof and everything else. That's why Brian coming in has got that as an area that he'll be picking up on. And we'll be working with everyone to try and get a nice clarity going forward. What you're also going to get, and I would really encourage you to come to the Capital Markets Day, is you're going to get terrified by what we can do. We are now the world's leader in automotive. We work with all of the motor manufacturers on telematics, cars of the future. We are the king of this area. We're actually the king of this area in maritime. We're moving into biometrics. I'm confident that we should be doing a biometrics demonstration in the Capital Markets Day to show you how, with a few household products, you can actually overcome some of the facial recognition systems that exist and other parts of it. We've just got to check a few things out, so I'm not guaranteeing it, and it's not quite Blue Peter. There won't be any sticky back plastic, but it's not far off that what you can actually do. And of course, the good old web performance business, the one that we don't talk about. Again, we're still seeing great recurring revenues in that area. So all in all, assurance is in a pretty good place. It's going to continue growing. It's going to continue growing well. But more importantly, we're actually going to give you a lot better ways of understanding it. Just some interesting metrics. Pretty terrifying, really. If you look at our SOCs, we received and processed, and this isn't a made-up number, 20 billion events. In our managed services, we're identifying over 500,000 incidents a month. That's a 56% increase year on year. We're in a pretty sophisticated space. It's a great area, managed services. Fox, I've given you the bad news about the government. Let's talk about the good news. What are the things we're doing? Much as I promised, we have a new MD. We've got a new CFO in there. And we've also got a director now who's got very good government relationships, who's responsible for the high assurance area of the business. Part of that was the integration plan that we were pulling together. So actually, we're well on track with Fox. And one of the biggest drivers for change, GDPR. This is huge, absolutely huge, not just for organisations such as us that provide consultancy, but for business as a whole. It is now absolutely categorically confirmed that this is happening on the 25th of May. That's compliance date. Every business now has to fundamentally change the way that they handle and process data. There has to be clear segregation. Individuals have to be informed within 72 hours if something's happened to their data. We as individuals get the right to determine what data is held by organisations. The process and storage of data within organisations has to radically alter. And that goes down to the minutiae of even the way that email addresses are stored in your inbox. If somebody doesn't want you to have it, you can't have it. End of debate. The fines are significant, 4% of global turnover. The good news, capped at 20 million, so it's not so bad, is it? But put that in context of TalkTalk. Their fine, the biggest one the ICO have ever levied, was 400,000. There is an incentive to get it right. Now, to put this in context, what does GDPR mean in terms of effort for a business? We are not a data-heavy organisation. We don't store great swathes of customer information. We don't have personal names and addresses. We're actually pretty light. For us to comply with GDPR requires 510 days of consultant time. So let's start thinking about an organisation that has proper customer data, any of the financial institutions. You would be terrified at the numbers that have not even started. For the first time ever, we've had an NCC Group sold out. Just around the corner at St Paul's is a GDPR event, which we optimistically booked a room for 90 people. We have 180 wanting to get in. Now, that doesn't mean NCC Group's revenue and profits are going to shoot through the roof at a ridiculous stellar rate, but in terms of a driver for change and people getting on the bus to get cybersecurity right, it's a pretty significant one. No, we probably would not be able to satisfy the demand in the market. GDPR consultants, risk management and governance consultants are actually a fairly rare beast. So it's good news. It's a great driver for change. Organisations can't leave it to the last minute, and I'd like to believe your organisations will be contacting me to let me assist you with, not me personally, I'd worry about that, but my team assist you with their GDPR requirements. And that works beautifully into the board responsibility, the cultural change that has to happen. And again, we're seeing support for government around this area. Risk registers now are beginning very slowly to mention cybersecurity, but not all of them. So again, all these changes are positive for our marketplace. Escrow, again, when I sit back and look at Escrow, and I swap sides and look at it as if I was reading the Escrow business, what a business that is. In a half year, nearly 19 million revenues, over 10.5 million EBITDA, a margin of 57%, all done with 166 people. And with a pretty high assurance that most of that's going to renew next year. Brilliant. And then I've got growth. Good, positive growth. 14% overall, but if I do it on a constant currency basis, that's 8%. Now, my memory is very good. Last year, when we delivered 8% growth. What I said is if I deliver 8% growth in the next full year, I'll obviously have to promise you more than the 4 to 6% that I traditionally offer. I'd like to believe it's going to be more than 6. I can't guarantee 8. We've done incredibly well in this half. US, stellar. 43%, but 18% on a constant currency basis. And actually, again, I have been challenged lots of times, what more can we do to capitalise in the world's biggest escrow market, theoretically? And that's what we're doing. We've actually taken one of our homegrown superstars and moved him to North America. It's a tough decision, move the family from beautiful Blackburn, Trafford Boland, to San Francisco. It's taken a while to get him to go on that journey, really. But actually, that's part of the ambition now. You know, the UK team is in great shape, so actually with the capacity to move that individual over is good. Europe, Europe's small. You know, it's less than 2 million revenues. It's obviously very profitable, but it ebbs and flows in terms of performance. As long as it stays positive or above that, then I'm very happy with that performance. And that leads us to where we are. You know, again, remembering the most valuable asset we've got, Escrow. It's in great shape. It's continuing to grow. Assurance, we're well positioned to take the benefits of GDPR. Organic growth will continue. Staff retention runs at the same incredibly high levels that we've always seen. Fox, it's slow. I recognise that. There are challenges. You know, we've been careful and prudent with it. It's a valuable asset that we want to make work. Domain services, it's gone. It's over. We're still on the lookout for small acquisitions. US boutiques, that's our forte. I can confidently commit to everybody, we aren't going to be writing big cheques for big businesses. They will all look or feel very similar to the small boutiques that we've bought, acquired, integrated and made incredibly successful in North America. So the PSC, VSR type acquisition will possibly, probably, be continued in the second half of the year. Order book's incredibly solid, as you would expect, and typically growing. And therefore, we have to be reasonably confident that we're going to produce a typical second half performance that we see within NCC Group, which is always skewed towards the second half. It always has been. And therefore, our belief is that the range that we provided the market will be where we will end up. So it's a disappointing first half. There's no point in pretending otherwise. But the positives that we can take from it, the fundamentals of the business, are very strong.